Here's a question. If you had extra money, would you pay off your mortgage early for peace of mind or invest it to build wealth? Well, it's not a simple yes or no answer. It's a strategic decision that depends on math, emotion, and your unique circumstances. And here's the kicker. What's right for you may not be right for someone else. In today's video, we're going to break it all down. How mortgage amortization works and why timing it matters. Key financial factors like interest rates, inflation, and investment returns. And finally, a blended strategy that could give you the best of both worlds. By the end of this video, you'll know exactly how to make the right decision that aligns with your financial goals. And it may even help you sleep better at night. Hi, I'm Kevin Elliott and welcome back to the channel. If you're new here, we simplify personal finance and empower you to make smarter financial decisions that enable you to build and preserve true wealth. Whether you're aiming for financial freedom or simply trying to optimize your hard-earned cash, you're in the right place. Today's question, invest or pay off your mortgage, is something that I get asked about all the time. And the truth is, there is no one-size-fits-all answer. But together, we're going to explore both options so you can make the best choice for your unique situation. Let's dive in. Understanding mortgage amortization. First, let's understand how mortgages work. Most people don't realize that mortgage payments are structured through something called amortization. And this has a big impact on your decision to pay off your mortgage early. Now let's put it into perspective with a real-world example. Imagine you take out a loan of 400,000 euros at 5% over 30 years. Over the course of the loan, do you know how much you would repay the lender? 772,000 euro. Yes, that's right, 772,000. Here's the breakdown. 400,000 is the original loan amount, and 372 is the interest that will be paid to the bank. So over the life of the loan, you pay almost double your original principal. This is the power and cost of compound interest working against you. In the early years of your mortgage, most of your payment goes towards interest, with very little reducing the actual loan amount or principal. As time goes on, this flips, and in the later years, more of your payment goes towards paying down the principal. So for example, if you have a 400,000 euro mortgage at 5% fixed rate over 30 years, your monthly mortgage payment will be 2,150. In the first month, only 481 goes to reducing your principal, and the balance of 1,669 goes towards the interest. Now, let's fast forward to the midpoint of the loan, year 15 or month 180. The repayment is still 2,150, but now a higher portion goes towards paying down the principal. 1,112 goes towards the principal, which is almost double what it was in year one, and the remaining balance goes towards the interest. Making extra payments early in the loan term directly reduces the outstanding principal balance. Since interest is calculated on the balance, a smaller principal means less interest is charged in the future. Over time, this can significantly reduce the total interest paid on the loan. For example, let's say you decide you can pay an additional 500 euro each month during the first 5 years of your 400,000 euro mortgage. 5%. By doing so, you reduce the principal more quickly, which means less of your monthly payment goes towards interest as the loan progresses. This not only saves you tens of thousands of euro in interest over the life of the loan, but it also shortens the term of the loan, potentially by several years. In other words, paying extra towards the principal early allows you to reduce the time it takes to pay off the loan and the overall cost. It's a simple yet powerful strategy for minimizing your long-term financial burden. Key factors to consider. Now let's dive into the key factors that will help you to decide whether you want to invest or pay off your mortgage. Number one is the mortgage interest rate. Your mortgage interest rate is one of the most important factors, and here's why. If your mortgage interest rate is low, say it's 3% or less, paying it off early may not be the most efficient use of your money. Instead, you can invest that money in, say, the stock market, which historically has delivered average annual returns of between 7 and 10%. Even accounting for taxes on your investment gains, you could still achieve a net return between 6 and 8%. This net return is higher than the 3% interest savings you get from paying off your mortgage. So investing is more effective in this scenario. On the flip side, if your mortgage rate is high, say it's 6% or more, paying it off provides a guaranteed risk-free return. In this case, reducing your debt makes more sense. An example, let's say your mortgage is 400,000 and a 3% interest. Paying it down early gives you a guaranteed return of 3% annually. But if you invest that same amount and earn an average of say 8%, you're effectively gaining 5% more each year. This difference arises because the savings from paying off the debt are capped at the interest rate, a fixed amount. Investments, however, have the potential for higher compounding returns over time, though they do carry risks. Volatility in interest rates and investment returns. The UK-based financial planner called James Shack posted an in-depth analysis of why you can't just rely on historical averages. Both interest rates and investment returns are highly volatile, and assuming stability can lead to misleading conclusions. For example, mortgage rates in the 1980s were above 10%, making earlier payments an obvious choice. However, in today's low-rate environment, investing may seem more attractive, but only if you can tolerate the risk of market downturns. Shack's data also shows that periods of high inflation and rising interest rates often coincide with increased market volatility. This means that even if you expect higher returns, the journey may not be smooth, and timing plays a crucial role. So, don't just compare averages. Consider how fluctuations in interest rates and investment performance could impact your long-term strategy. Investment and the real cost of debt. Inflation is often overlooked, but it's a key consideration when deciding to keep or pay off your debt. Over time, inflation reduces the real value of your mortgage. For example, if you owe €400,000 today and inflation averages 3% annually, that debt will feel like €220,000 in today's money after 20 years. This means holding on to a low fixed rate mortgage during high inflation periods can actually work in your favor. The debt becomes cheaper in real terms, while your assets like the home or investments may grow in value. Prepayment penalties. Before you start throwing extra cash at your mortgage, check your lender's rules. Some loans have prepayment penalties that could offset your savings. Some lenders charge an early repayment charge if you pay more than 10% of your monthly mortgage payment each month. Other lenders charge only if you repay a lump sum more than 10% of the outstanding balance in a single year. Compare this cost to the long-term interest saving to decide if paying extra is even worth it. Investment returns. If you're leaning towards investing, your portfolio returns need to beat the mortgage rate after taxes. For example, if your mortgage rate is 3%, your investment need to be at least 4 to 5% pre-tax to make investing worthwhile. Why? Because taxes and fees reduce your net return. If you're in a 40% tax bracket, a 5% pre-tax return essentially drops to 3% after taxes, which just doesn't beat the mortgage rate. This is why investors must consider tax and implications and the net returns, not just the headline numbers. Tax efficient savings opportunities. One often overlooked benefit of paying your mortgage down is the cash flow that it frees up. This free cash can be redirected into tax advantage accounts like your pension or retirement savings. Let's look at an example. Say your monthly mortgage is $2,150. After paying down a portion of your mortgage, your monthly repayment drops to say $1,650, saving you $500 per month. If you invest this $500 in a pension plan and you're in the 40% tax bracket, every €500 contribution effectively only costs you €300 out of pocket. Over a 20-year period, with an assumed 7% annual return, this €500 monthly could grow to over €260,000. That is a significant boost to your retirement savings. Liquidity and emergency savings. It's also important to think about liquidity. Once you pay off your mortgage, that money is tied up in your home. If you face an emergency, it's harder to access compared to liquid investments. A good rule of thumb is to keep between 3 and 6 months of living expenses in an emergency fund before aggressively paying down your mortgage. This ensures that you have a financial cushion for unexpected events. The blended approach. Now, here's where things get interesting. You don't have to choose one strategy or the other. A blended approach could offer you the best of both worlds. Let's say you have €100,000. You could choose $50,000 to pay down your mortgage, saving on interest, and invest the other $50,000 for long-term growth. Why does this work? Well, by paying down $50,000 on your mortgage, you immediately reduce the principal, which lowers your monthly payments and your total interest. Meanwhile, the other $50,000 invested at an average of say 7% annual return could grow to around $190,000 in 20 years. This approach balances risk, liquidity, and long-term wealth creation. By blending the two strategies, you're reducing risk while still taking advantage of growth opportunities. Essentially, it's a win-win for a lot of people. Emotional and lifestyle factors. While the math is important, your decision isn't just about numbers. It's also about peace of mind and what makes you feel secure. So, number one, peace of mind. Imagine waking up one day and knowing your home is fully paid off. For many people, that feeling of freedom is priceless and worth more than any potential investment return. 2. Risk tolerance. Investing comes with ups and downs. If a market crashed right before you needed your money, would it stress you out? Paying off your mortgage may be a safer bet. 3. Your big picture. Think about your overall financial situation. Are you already investing heavily in certain areas? Or do you have limited savings? A balanced approach can help you ensure that you're not overexposed in one area or another. To sum it up, if your mortgage rate is low, investing often makes sense. If your mortgage rate is high, paying it off early could be a smarter move. But a blended approach offers flexibility, balancing the short-term security with long-term growth. Remember, this isn't an all or nothing choice. The right answer depends on your risk tolerance, financial goals, and what helps you sleep better at night. What's your approach? Are you on team pay off the mortgage early or prefer to invest for growth? Let me know in the comments below. I would love to hear your thoughts. If you found this video helpful, don't forget to like, subscribe, and share it with anyone who may be facing this dilemma. Your support helps this channel reach more people looking to make smart financial decisions. Thank you for watching.